please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
I have a very interesting guest with us, Suresh Ganapathy. Macquarie held a week-long roadshow in Europe recently, and among the important takeaways is that macro worries are clouding the India outlook. Suresh, we read that in your report, but tell us more about the investor concerns. We are meeting you in the backdrop of the way the Turkish lira has gone. But do you think the macro concerns have played out now in India, and we are not as bad as we were, say, 5 years ago in 2013?
Yeah, of course. Relative to what we were in 2013, we are in a better position. But then we have to look in the context of the fact that how rates were, say, a couple of years ago. We have gone through unprecedented bouts of liquidity in the Indian markets. And now, at the margin, over the course of next 6 months, we are going to see liquidity remaining tight, rate cycle reversing, oil prices remaining high. So if we were to look at India compared to what it was, say, 6 months ago, definitely there are macro worries. And valuations in that context definitely still look pricey for India, and therefore downside could be relatively higher in the near term.
Okay. Hi Suresh, good morning. The trade up until now was, go long on private banks and, sell the PSU banks or not own it. Does that still continue, from the investor point of view?
Yeah, that's true, Sonia, because barring SBI, remember that all the other large PSU banks run a big risk of consolidation, in the sense that they will eventually be forced to acquire banks like IDBI or Indian Overseas Bank with 20% plus gross NPL ratio. So clearly investors are definitely not going to make money holding these stocks. SBI is the only one where clearly you can see improving return ratios without any risk of consolidation, to be honest.
Okay. Suresh, good morning. So on SBI in particular, what is the market now betting on? Because for last 2 or 3 days, we have actually seen quite a big rally despite the bank posting the largest ever loss.
I think that's because Suresh, after all these years,
that's
put a
true.
buy.
So if you look at it, no, I have a neutral Lata. Okay. I've still not made it a buy. Okay. But having said that, neutral recommendation itself is something which I've never done for PSU Bank. So to that extent, maybe you can take it as a positive bias or a view. Having said that, look, the context here is for the largest bank in the country, and the valuations are closer to 0.8 times or 0.9 times FY20 price to book. So it is still less than 1 time price to book. And having said that, if one were to believe that there will be some normalization of credit cost happening over the course of next couple of years, we might see a double-digit ROE, which is what is there in the numbers. So to that extent, you are getting SBI less than 1 time price to book, and more importantly, their capital position is relatively better compared to other PSU banks. And as I have been saying, that they don't run the risk of acquiring any of the weaker PSU banks. Definitely, market has taken that positively, that after all the kitchen sinking which has been done, things should be on a recovery path for the next couple of years for SBI.
Okay. Well, I'll come back to the other corporate lenders and retail lenders in a minute, but let's discuss the NBFC space. Obviously, huge rally in 2017. Yeah. Which part of the space will you still be comfortable, and where will you be terribly uncomfortable?
Yes, so if you were to look at it, clearly the well-rated housing finance companies, for that matter, whether it is HDFC Limited or Indiabulls Housing Finance, they are all AAA rated, and they have shown many times in the past their ability to manage their ALM even in a rising rate cycle. So I think they should be in a better position, to be honest, to tide over the current tight liquidity conditions. The real problem, Lata, what happens is that more than the actual performance on margins, or for that matter your overall returns, the valuations tend to correct in a rising rate cycle. So some of the very pricey NBFCs, be it say Mahindra Financial Services or Bajaj Finance, or for that matter any of the other conglomerate NBFCs like Edelweiss or India Infoline, there is a possibility that because of the high multiples that market has been awarding to them over the course of last couple of years and the re-rating that we have seen, there is a possibility of slight correction in them, mainly because of the rising rate cycle. So I'll stay with quality housing finance companies, AAA rated in this environment, who can tide over the cycle relatively better.
Suresh, where do investors stand on Axis Bank as well as ICICI Bank? Both the stocks got hammered on account of fears of top management issues, but in the last 1 month, they've recovered nearly 5 to 10% from the lows.
Yeah, so if you look at comparison between both, in fact the triggers are more or less similar because both of them are very much contingent on the corporate asset quality cycle recovering. Having said that, ICICI trades at a clearly 40% discount to Axis Bank, so it definitely falls under the radar of value funds, mainly because of the fact that it is really cheap, and for a private sector bank trading at one-time price to book, if you were to look at core price to book valuations, it's really pretty cheap. And moreover, even from a capital position, ICICI Bank is a bit more comfortable than Axis, and secondly, there is enormous value coming from subsidiaries for ICICI. So all these things put together really puts ICICI slightly in a bit more favorable position compared to Axis, and that's what we clearly felt amongst investors, that there was more interest in ICICI than Axis, clearly amongst the European investors.
Okay, last year around March, many of these NBFCs were raising money hand over fist at really rock bottom rates. I mean, even 7 point something. Now, some of them have to pay back some of those debentures, and today DHFL is raising at 9%. Of course, it's 10-year, but 9%, and they're offering 1 percentage point more if you hold it to maturity. The rise in cost is steep.
Yeah.
Can they, if they have to, pay back the old money, can they really deliver the kind of growth that they delivered? And will there be a problem of bad loans because you will have to reset your old loans?
No, so if you look at it, Lata, the sensitivity of rising rates with respect to asset quality, retail asset quality at best has been tenuous. It's just because you have to pay 100 basis point more on a mortgage or a CV loan, people start defaulting. I doubt that is likely to happen. What is this going to result is that if you're going to chase growth more at this higher cost of funds, clearly it is going to come at a lower profitability because margins are going to be under pressure. So same growth can be delivered because, as I said, the level of under-penetration is low. PSU banks have been losing market share. So to that extent, growth could still be sustained, but clearly it will come at much lower margins, in my opinion. So profitability overall this cycle, at least in the next 12 to 18 months, as long as rates remain very high, will be definitely lower for these NBFCs.
Suresh, many NBFCs, especially housing finance companies, gave us 40%, 50%, 80% loan growth. So, people may not default simply because EMI has gone up or rates have gone up by 1%. But if you have grown 80%, some of those loans could be questionable borrowers.
Yes, so we really need to see the kind of mix that you are looking at, Lata, because, whether it is salaried versus self-employed. Self-employed obviously has a higher risk, whether you have done more LAP, because a lot of people mix LAP in the retail home loan category and then show it 60-70% kind of a growth. So it all is going to be a contingent of the fact that what kind of loan mix is basically constituting that 80% or 50% growth that you're talking about. So to that extent, we will relatively be a bit more conservative. So if you've done more in the 3 million kind of a ticket size category, the asset quality has been best in that segment. Okay. Clearly, as you go down much lower ticket size of less than 1 million in the affordable housing space, NPLs have been relatively higher. Or if you've gone to a very high ticket size or a LAP kind of a portfolio which is greater than 10 million, clearly asset quality has been an issue. Okay. So we really need to have to bifurcate growth to get a better clarity.
Okay, by the way, just take a look at Tata Motors now. And that was always going to be a problem with this stock. So 6% now gone on Tata Motors, and just 2 days back you had really stupid rally on this one, in a sense that there was this China news and where the stock rallied from 52-week lows, and this JLR pain still continues, and even in standalone numbers this one actually has underperformed Ashok Leyland in a good cycle. So this is one area where we've been making this point consistently, that don't preempt the jail. Once the turnaround comes, then perhaps the time would be there. But
actually, they've under-delivered on in good times, as it were. CV cycle in India is good. Global, consumption cycle has been good in Europe, in the US. And in spite of it, Tata Motors has not quite taken advantage of that. So severe falls coming in the Tata Motors stock. Well, Suresh, can you name, therefore, your NBFC picks?
Yeah, so my top picks in the NBFC space is Indiabulls Housing Finance and Cholamandalam Finance. Both of them are excellent power of compounding stories. So we really see strong returns and strong growth in both of them. in the NBFC space.
Okay, and just finally, I wanted to ask you about, how will the world of finance look 2 years from now? There are 11 banks which account for 20% of the market share, which are in PCA. 5 more may get there if you looked at the way the results have panned out. So with perhaps 1/3 of the market share banks kind of paralyzed in terms of opening branches, collecting deposits, what will be the mix in terms of public and private, and who will be the biggest beneficiaries of this paralysis?
Yeah, so if you look at since 1990s till in the last 30 years, PSU banks have roughly lost market share of about 25 to 30%, right, to the private sector space. So there has been a roughly acceleration, or rather a rate or run rate of about 1 percentage points market share loss over the last 30 years. And I think things would really get a bit more worse for them over the course of next 10 years or 5 years for that matter,